Hello and welcome everyone, and thank you for joining us for this educational webinar hosted by Foundant Technologies. My name is Mark Larimer. I'm one of Foundant's founders, and I currently oversee our client services and marketing teams here at Foundant Technologies. And today we're very pleased to be sponsoring today's webinar in conjunction with Exponent Philanthropy on recognizing and avoiding self-dealing and conflict of interest issues. This was a very surprisingly hot topic today. We have well over 525 people registered for today's webinar. Probably will have 200 to 300 people in attendance. And we're extremely pleased to partner with organizations such as Exponent Philanthropy to bring these types of topics to such a large audience and to provide this resource to all of you. So hopefully you find it extremely interesting. Before we begin, though, you will notice that we are using GoToWebinar as the technology platform to run this event. So I would like to call your attention to a couple of the tools that you'll see on your GoToWebinar console. First, you'll notice the Grab tab. This is the orange arrow that appears in the upper right-hand corner of your screen. You can click on the orange arrow to either minimize or maximize the GoToWebinar control panel. To better view the full screen, you will want to most likely minimize that control panel. But when you want to send us a question, you'll need to click on that orange arrow again to maximize the control panel to access the question area. We will hold a couple of Q&A sessions with Andras, our speaker, both during the presentation for a short period of time as well as after the presentation as well. So do please type in your questions in the white box where you see the words "enter a question." Simply type in your question, hit the send button. Please do note that we will not be using the raise your hand feature for questions. We simply have too many people on the webinar. However, I will be gathering up your questions you've typed in. I'll direct them to Andras at the end of the session. So please do type in your questions as they come to you throughout the course of today's webinar. Finally, if you have any technical difficulties with the GoToWebinar system during this event, please feel free to reach out to GoToWebinar tech support at 1-800-263-6317, and it's option number 2 for technical support. Before we jump in, though, I would like to just provide a quick overview of what you'll be hearing in today's webinar. I'll provide a quick introduction to today's topic, as well as Foundant Technologies as a whole, for those of you who are not familiar with us, as well as Exponent Philanthropy, for those of you who may not be as familiar with them. The rest of today's presentation will largely be Andras presenting on the most common legal issues facing foundations in conjunction with self-dealing and conflict of interest. As can be seen, based on the number of people attending today's webinar, self-dealing and conflict of interest questions is a pretty hot topic, and people want to better understand the issues and to stay within the rules, which we very much appreciate. As I said, we will be taking questions from the audience today, but we do anticipate many questions, and will most likely not be able to answer all of them in the time allotted. However, if you do type in your questions, I will be going through them while Andras is presenting, looking for the ones that have the most common themes, and we'll ask Andras to go through as many topics as possible in today's webinar. Please do be sensitive on a webinar such as this with over a couple hundred people in attendance. We cannot necessarily go into specific detailed type questions that you may have, so there might be ones that you still will need to consult your own lawyer or counsel as needed. So a little background on Foundant Technologies. Foundant is actually headquartered in Bozeman, Montana. So we're just a stone's throw away from Yellowstone National Park. But we have remote employees in 9 different states across the United States and have been growing rather quickly over the past 11 years. And that can be demonstrated a couple different ways. One is just by a number of clients that you can see on this map, as well as Foundant being named to the Inc. 5000 list the past 4 years in a row. We have over 1,200 grant-making clients using our online grant management system, Foundant GLM, which is what we're the best known for. However, we also have a product known as Grant Hub, which is our solution for grant seekers to manage their grant proposal process. We launched that product a little over 2 years ago and already have over 400 nonprofits using that solution. And then finally, a little over a year ago, we began selling the Community Suite product line, which is a multi-fund accounting, donor management, and crowdfunding solution for community foundations. And we're currently at 56 community foundations using Community Suite and another 105 using us for grants and scholarship today. And again, that number is growing rather rapidly right now. So that's who we are. Many people do think that we're for small to medium-sized grant-making organizations exclusively. That's where we probably have the bulk of our early customers. But in fact, we actually work with a variety of different grant makers of different types and sizes. A much bigger indicator of success for us is how well we match a grant maker's workflow and processes. So we have grant makers as large as a couple billion. We have some that are extremely small. Again, we kind of work with our prospects and clients to match our system to their needs. Foundant is up to over 83 team members. That has grown rapidly. We added almost 40 people this year alone. But we are extremely proud of being named to the Outside Magazine's top 100 companies to work for the past 4 years in a row. Making that list is actually largely based on our employees' response to an anonymous survey. It's extremely competitive. There is no cost associated to participate. And actually, we're one of only 2 companies to have made that list the past 4 years in a row, while at the same time making the Inc. 5000 list as the fastest growing companies in the United States. So we're balancing both growth and culture, which is something that we're extremely proud of. Well, now that you kind of Foundant a little bit better, I would like to provide just a quick overview of Exponent Philanthropy. Exponent Philanthropy is the country's largest association of funders and the only one dedicated to serving foundations with few to no staff. They serve philanthropic families and individual donors as well. Foundant has actually had a relationship with Exponent Philanthropy since almost our inception. They've actually been much more than just partners to us over the years. They've provided us with guidance, and they've provided us with access to their vibrant network of members that have in common, lean operations, just do what you can type of attitude, and a style of philanthropy motivated by personal passion, community needs, and a strong desire for better outcomes. Over 200 of our clients are Exponent Philanthropy members, and they consistently tell us and cite the high quality of their cost-effective programs, their resources, and the connections that they've gained through their relationship with Exponent Philanthropy. So with that, I'd like to turn things over to Andras, and we'll switch screens, and he'll be taking you through today's presentation. So Andras, I will switch control to you.
Great. Thank you, Mark.
And you can take it away. Oh, there you go.
There we go. Great. Thank you, Mark, and welcome, everybody. Thank you for joining us. As Mark said, this is one of the hot topics that foundations of all sizes care about, self-dealing and conflict of interest. One of the reasons it is such a popular topic is, one, because there are penalties involved potentially if you're in violation of the self-dealing rules. And of course, everybody wants to avoid those penalties. But second, because the analysis can be very fact-intensive and fact-specific. But to help with that, there are a framework that you can keep in mind when thinking about self-dealing and conflict of interest that will at least help you orient your thinking about self-dealing and whether a particular situation is a potentially a self-dealing violation or not. And we'll talk about those steps that you can run through. So the definition of self-dealing is it's a direct or indirect transaction between a foundation and a disqualified person. And the disqualified person is a defined term in the tax code. And we'll talk about that, what the definition is. Basically, think of them as insiders. And these are the 3 steps to identify self-dealing. First, you want to ask whether the transaction or arrangement at issue involves a disqualified person. And I always like to advise foundations to, if your family structure is complicated or you have a lot of board members, sketch out who your disqualified persons are. Just write them down on a piece of paper. If it's very simple, then you can sort of keep it in mind, but it can sometimes get very complicated, especially with multiple generations involved. Second is the transaction listed as self-dealing. And then third, does an exception apply? So we'll go through each of these. So this is the definition of a disqualified person. The obvious ones, the officers, directors, and basically the executive management team of the foundation managers. Those are all disqualified persons. The substantial contributors to the foundation, um, the family members of all of those above. This includes the spouses, ancestors, descendants, so the line up and down, and their spouses. The one strange exception here is siblings are not listed, are not disqualified persons, and not entirely sure why Congress made that exception. It's perhaps something to do with sibling rivalry. Maybe Congress trusted siblings to keep each other in checks and balances, but it exists and it's an exception. And then entities controlled by disqualified persons, and then certain government officials. The second is the transaction listed as a self-dealing. And these are all these six categories of transactions potentially involve self-dealing. And we'll go through each one of these. So the first one, sale or exchange or lease of property. So, and I'll talk about within each category, I'll talk about some of the common issues that arise within each category. So the sale or exchange of property between a foundation and disqualified person is prohibited. There's an exception to this. For example, if a disqualified person wants to provide property at no charge to the foundation. And the common issue here is the rental of office space, the rental of property to the foundation. So a family office or a family business may have office space, and they may lease it or rent it to the family foundation. And then they can do that as long as there is no rent that has to be paid by the foundation, so no charge. And that's what sometimes happens. And certainly the foundation on its own can get office space and pay for it from unrelated parties. This is a fairly easy one, and I usually don't hear a lot of complications and trouble figuring this particular rule out. Second is furnishing of goods and services to the foundation. So to disqualified persons. So that's prohibited. And the way this comes up is two things. One is the disqualified persons can provide goods and services to the foundation at no charge. Again, and this comes up, for example, in situations where, let's say that you have a family business has a paper printing or stationery business, and they want to provide stationery to the foundation. You can do that at no charge to the foundation. The reverse is that second bullet: if goods and services are offered to the disqualified person on the same basis as is available to the general public and is related to the foundation's charitable purpose. And an example of this is, let's say that the foundation has office space or a building that has excess capacity where that is being used by grantees and charities in the community for conference space, for meeting space, and the foundation maybe charges a nominal fee for use of the office space, or sort of a fee that's equivalent to the cost of using that space to the charities. And a disqualified person, for whatever reason, would like to use that same office space as well. And you can do that as long as it's on the same basis and no more favorable than how it's made available to others and to the general public in that community. In my example, so again, this usually doesn't come up too frequently, but that's the idea behind this rule and the exception. Lending of money or extensions of credit to a disqualified person is prohibited. Um, this is two examples here. So one, again, the exception here is that the disqualified person can always lend money to the foundation at no charge, no interest rates, um, and for purposes to be used to further the charitable purposes of the foundation. Again, this could come up in a number of circumstances. Let's say the foundation needs to purchase real estate or needs to purchase equipment or do something where it would like to take advantage of a loan from a disqualified person. The disqualified person can provide that loan to the foundation at no cost. This also comes up more commonly with the use of credit cards. And the way to think about that is if let's say that the foundation has a foundation-owned credit card, and the disqualified persons, the insiders, happen to charge a personal item on that credit card by inadvertently, then technically the foundation is making a loan to the disqualified person for that amount, whatever item was being purchased. And it could be a cup of coffee for $2, or it could be a sweater. It doesn't really matter. It would be an extension of credit that would be prohibited because the foundation cannot provide any loans or extensions of credit to disqualified persons. So that's something to watch. I would say as a general rule, I tend to recommend that foundations, unless it's absolutely necessary and it's really efficient for foundations not to have a business credit card, and simply just to have a very good policy of reimbursing any type of expenses incurred on behalf of the foundation in a timely manner, and to have a good reimbursement policy. So to avoid having a business card for the foundation. Now we get to compensation. This is one of the this is a popular exception here, of course, where payment or compensation or reimbursement of expenses of a disqualified person is generally prohibited, except, and here comes the exception, which we all know, except for professional personal services provided for the benefit of the foundation. So this is trustees can receive compensation, trustee fees for attending board meetings, committee meetings, for doing the work of the foundation. If the foundation, for example, is not staffed, if it's the trustees that are doing the grant's due diligence, making the decisions, and you want to compensate trustees for all that work, that's possible because that is personal services, that is foundation work being done for the benefit of the foundation. Similarly, the personal services then has a couple of other specific definitions and exceptions. So personal services will also include investment services. So if a board member manages some of the investment assets for the foundation, that board member can be compensated for that service. Accounting services, banking services, legal services, that all falls within the definition of personal services, and disqualified persons can be compensated for that. Beyond those examples I highlighted, which are generally defined in the regulations themselves, it's unclear what else falls within personal services. And we have a lot of guidance and revenue rulings and private letter rulings from the IRS that give some sense as to how the IRS defined this category. And broadly speaking, you can say that it includes sort of white collar types of jobs. We get the questions about, well, can you employ a disqualified person to develop the website for the foundation? Can you hire a disqualified person to do grants management, to do sort of grants consultations for the foundation? Those, we don't have specific guidance from the IRS on that, but those generally should qualify for the personal services exception. Certainly, when you do fall within the exception, the compensation or the amount of reimbursement has to be reasonable and necessary, and cannot be excessive. So the example here, for example, is the travel to board meetings and conferences, reasonable board fees. Again, a lot of different scenarios can come up, especially with board meetings and conferences, specifically in connection with spousal travel. And again, when you think through the rules, take the example of spousal travel. Can you reimburse the expenses for having a spouse travel to a board meeting? Well, first, are they a disqualified person? Well, yes, they are a disqualified person because they are, say, the spouse of a board member. Can a disqualified person be compensated or reimbursed for expenses incurred? Well, the general rule is no, except in certain situations. So here, the exception would be for reasonable expenses incurred in connection to personal services. The personal services here would be if this spouse had some sort of role and responsibility, an official role and responsibility in connection to the foundation's management. So if they are obviously also a board member, that would qualify. If they are maybe an officer or an employee of the foundation, that would qualify. If they have no role with the foundation, then they cannot be reimbursed for their expenses to attend a board meeting. A last exception that sometimes comes up is the foundation can buy directors and officers insurance. Many foundations have directors and officers insurance. It's something that we generally encourage, although I would say in the vast number of cases, you will never have the opportunity to use it or need it, which is a good thing, but it's nice to have. So that's with respect to compensation. It's a big category, and the reason it's a big category is, and the reason it makes it difficult sometimes is because the definition of personal services is not always very clear. Okay, now another category. The transfer or use of income or assets of the foundation to a disqualified person is prohibited. Now, I like to call this category the catch-all. This is sort of, when you think back to these others, right? This is compensation, the lending of money, the goods and services, the sale, exchange of property. Those are very specific. This last category, if you read it, it's very broad. Transfer or use of income or assets of the foundation. It's the catch-all category. And this is where, if you look at the common issues, this is where your tickets to fundraisers fall, your fulfilling charitable pledges. We'll talk a little bit about it. But this is, if you can't fit your specific scenario into one of those other categories, think whether it would fall under this category and whether it would be prohibited or fall within an exception. And the exception is if the benefits that a disqualified person received as a result of the use or transfer of the income or assets of the foundation are incidental and tenuous. And again, why is this a difficult category? One, because it's very broad, and two, because the definition of incidental and tenuous is not clearly defined by the IRS. And hence, why you have to call your lawyers every single time when you might fall within this category. So one definition of incidental and tenuous that we know with certainty is the use of names, the generation of goodwill, and name recognition overall. So we sometimes get the questions of, if the foundation makes a grant to a university, can the foundation request that the university recognize, whether it's a naming of the building or a plaque or whatever it is, the name of a specific board member or the individual name of the founders, as opposed to the name of the foundation? And you can understand the reasoning behind the question is because it's a benefit. Now, the IRS has said in that situation that the benefit, whatever is being generated, is intangible. It's name recognition, maybe generating goodwill, is incidental and tenuous, and will fit within this exception. So that's permitted, and that sometimes happens. And that also, for example, happens with company foundations as well. So a company sets up an affiliated foundation and wants to have both the company foundation, but as well as the company recognized in press releases and other materials. Again, that's permitted. The second common situation that arises here is the fundraisers, right? Tickets to fundraisers. So let's say that you make a grant, or you want to, you make a grant to a grantee, and they have an annual gala or fundraiser, and they want to send the foundation some free tickets, or even if it's not free tickets, the foundation wants to buy a table at a grantee's annual table, and invite and have spouses and friends attend the gala, not just board members. So in that situation, again, we'll walk through the rules. So you have a situation where there's a transfer or use of the income or assets of the foundation for the benefit of a disqualified person, right? The board members are attending, and they're trying to invite somebody who has no official role with the foundation. So that is providing more than incidental and tenuous benefit to the board member who otherwise would have to purchase tickets on his or her own. So generally, that's going to be prohibited. Now, I tend to look at the situation very carefully and really think about what are the facts and circumstances here. And one of my rules of thumb here is, if somebody really does not want to go to this fundraising event or gala, then it's probably fine to take your spouses and friends along with you to share the pain, because they probably will not be thinking of this as a great benefit to themselves. On the other hand, if you really want to go to this event or gala because there is a celebrity speaker and it's the hottest ticket in town, that is probably a good clue that it's something that you should not be taking your spouse or friends along for the event. That's a quick rule of thumb. But I certainly have encountered situations where, for example, you might be, as a foundation, very supportive of a grantee in your local community. The grantee always does an important fundraising event at the end of the year, and it is important for you as board members, but for you as member of the community, to attend that meeting, to have spouses or other friends, or open your network and get other folks to come and introduce them to this grantee. And I think in some of those situations, you can make a good argument that there is no incidental tenuous benefit. You're really doing this for the benefit of the grantee, and so it would be fine to bring along your spouses and friends. So there are some rules of thumb here, and I think there are some circumstances where this is permissible. So I usually don't say that tickets to fundraisers, it's an absolute prohibition. Fulfilling charitable pledge, I think that's probably something that hopefully most people are familiar with, and that's generally what it says is, if a disqualified person in their personal capacity makes a legally binding pledge to a grantee, then the board member, let's say, who made that pledge in his or her personal capacity, cannot turn around and ask the foundation to fulfill that pledge. That would be self-dealing. You would have to unwind the pledge, and then the foundation could pay it, but you would have to unwind it first. And it's a narrow rule because it technically applies only to legally binding pledges. The difficulty here is that what is legally binding is determined based on state law and is not always clear. So anytime there's a charitable pledge involved, you need to be alert. This last category I'm actually not going to cover, but it's a payment of money or property to a government official. It's prohibited. There are some exceptions. So let's say you want to have, this sometimes comes up in cases. There are every once in a while situations where a government official might be a board member of a foundation. There are also situations where maybe a government official is invited to a conference or an event, and there's some reimbursement of expenses, et cetera, et cetera. So this sometimes comes up in those situations. But even if you satisfy the self-dealing rules, you would just put in the back of your mind that you would also have to make sure that any government ethics rules and specific rules that apply to that individual in their capacity as a government official would have to be complied with as well. So it's a category that it's not just a self-dealing problem, but you'll have to make sure you run down the rest of the compliance issues. And then, as I said, why do we care about self-dealing? Well, we care about it because there are penalties involved. So the disqualified person pays a 10% penalty tax, plus you have to undo the transaction, so repay any of these benefits that a disqualified person may have received. Foundation managers that approve the transaction, so let's say the board approves the transaction, there's a penalty on them as well. That's capped. The penalty becomes basically very high for good reason if it's not corrected. So the penalty, basically, you have to undo it and pay a penalty. If you don't do it, it's a problem. And the penalty is not on the foundation. The penalty is on the individuals, the disqualified persons who are receiving the benefit. So I think this is a good place to stop. I wanted to pause for maybe a question or two before we talk about conflict of interest.
Great. And there's lots and lots of questions in here, so I'm going to try and organize them a little bit. I think there's at least, there's one real quick one I'll get out to everybody because I've answered it many, many times. Yes, we'll be providing a recording and the materials in a follow-up email, so you will be provided with that information. So the first one that had some maybe a qualifying question for you is, if you could clarify whether the executive director non-family is considered a DP or designated person. Wasn't sure if just by the director title referred, if that's the ED, directors of the board, or who. So can you give a little bit more who would fall underneath that DP designation?
Sure. Sure. So the foundation manager is a non-family member executive director would be a foundation manager and therefore would be a disqualified person. So anyone who has a foundation manager role, and let's take the example of a very large foundation, where there might be vice presidents, sort of the senior managers of the foundation, each of whom may be in charge of large segments of programming, each of whom might have authority to sign checks up to a certain amount and make decisions about various things. Those generally would all be disqualified persons. So it's what are their roles and responsibilities in terms of who's a disqualified person for those individuals who are not directors and not family members. I would say that a grants manager, or if you have, let's say, an executive director at a smaller foundation and maybe one grants manager or a program manager, the program manager would probably not be a disqualified person, especially if they don't have signature authority, if they're not allowed to sign contracts or write checks.
And then there are a ton of questions that are kind of related to spouses. So spouses with no role on the board attending lunch meetings and paying for lunches or travel if they're going to conferences and things like that. There must be 6 or 8 questions that relate to spouses.
Right. So again, what you really have to keep in mind with respect to spouses is if they have no official role and responsibility with the foundation, then I think my general inclination is to, without knowing more, my general tendency would be to say that no, those individuals cannot attend a luncheon that the foundation pays for, or an event that the foundation pays for, unless they pay sort of their portion separately, which can obviously be sometimes difficult. There are situations where, for example, a next generation board, where you are grooming the next generation. They don't have an official role with the foundation. They're not board members, but you have a formal policy and program for getting them familiar with the foundation's work, and that eventually will lead to being appointed to the board. In those situations, you can have foundation organize events and pay for those events and have those individuals attend those events. Again, because you're showing a specific program that is geared towards getting them familiar with the foundation and eventually rotating them onto the board.
Okay. Do we need to move forward, or do you want one more question?
Let's take one more.
All right. There are a few different questions around compensation. So compensating staff who are related to the organization or compensating board members to the organization. And there's probably 6 or 8 different questions around how to kind of determine reasonable compensation for family members or people who are related to the organization or board compensation.
Yeah. That's a great question. And how do you determine reasonableness is basically going to be based on comparability data. So reasonableness is defined by, through the eyes of the IRS, what a similar person under similar circumstances for similar work at similar organizations would be paid, i.e., you have to look at comparability data. Exponent Philanthropy has comparability data. They put that out in a publication. And there are other infrastructure groups that have comparability data as well. If you can also pull some comparability data on your own through by looking at 990s of other organizations, and you can get those from GuideStar. Just download them. And when the IRS does audit, and let's say it's an audit regarding compensation, they are going to be asking whether you looked at comparability data. And in my experience, if you can show the comparability data and you fall within the range of comparability data, then that's sufficient for the IRS. When certainly the amount of work you need to do in terms of comparability data depends on your specific facts, circumstances. Oftentimes, just pulling the data from Exponent, for example, will be sufficient. If there is if the compensation is potentially high based on comparables, or you have sort of sophisticated and complex benefit arrangements, incentive compensation, bonuses built in, which all are permissible, but you might want the assistance of a compensation consultant who can really tailor the comparability data and advise you what's market rate, what's standard, what other foundations are doing. We certainly use compensation consultants with clients, but there are also times where it's not necessary and you really can just pull data yourself. Okay, so let's turn to the conflict of interest, and then we'll have a little time at the end to keep coming back to questions. So conflict of interest, I think of conflict of interest as the broadest category of a situation where there's potentially a benefit to the individual, to the insiders of the foundation, as a result of some sort of arrangement or transaction between the individual or family members of the individual and the foundation. And think of the self-dealing rules as a subset of the conflict of interest rules, because conflict of interest will encompass both financial transactions as well as non-financial transactions. And conflict of interest can be a lot broader than just the definition of disqualified persons under the self-dealing rules, right? It's a fairly broad definition, but it's still narrow. It doesn't pick up siblings, as we talked about. But with conflict of interest, you can define who is encompassed within the definition however you like. And the other category of folks that often fall outside of the self-dealing rules is the staff, the employees of the foundation. We talked about the executive director, who generally would be a disqualified person, but some of the lower level employees would not be. But your conflict of interest policy should pick up all of those individuals. So here are examples. A foundation board member serving on a grantee's board. It's not a financial conflict of interest. This is a conflict where, should the foundation be making a grant to a grantee where there is an overlap among board members. The foundation board member's nephew serves as an executive director of a grantee. Again, this is not a self-dealing issue because of the sibling exception. But again, is this something where there's potentially a perception of self-dealing? Is there a perception of a financial benefit to the executive director? What are the circumstances? Third is spouse of foundation board member has a brother who owns a business that may become a vendor to the foundation. Again, not a self-dealing because it's a sibling here. But what's the reason? What's the purpose you're doing it? Is it reasonable? So how should we think about conflict of interest? In the same way, how did we think about self-dealing? So there are steps we want to follow. One is board members should disclose potential and possible conflicts to the foundation. And second, you want to follow your written conflict of interest policy to help manage and resolve conflicts of interest. So the disclosure should happen on an annual basis, once a year. You might submit a sort of written statement on the boards a board member may sit on, and you could also have a sort of an ongoing rule where if a conflict arises, then you need to disclose it, even if it's not provided on the annual disclosure. So anytime a potential conflict comes up, you want to raise your hand and disclose that. And second, you want to follow your written conflict of interest policy. The vast majority of foundations and nonprofits at this point have a written conflict of interest policy. If you don't have a written policy, you really should have one. That's just industry standard at this point. The same way it's industry standard and best practices. Same way you should have a written investment policy. So what are the steps? How does the conflict of interest policy help manage and resolve the issue? Well, so one is the disclosure. So the conflicted person shares the information. The conflicted person should be able to, again, provide information, but should not be part of the final discussion. So you should always have a part of the discussion that happens without this person being in the room. So you can have a free discussion about the arrangement. And then the conflicted person should not vote. It should be recused from voting. And in the board minutes, you should note both of these facts, that the individual was not in the room during the final part of the discussion and did not vote on the arrangement. And as I said, you should document all of these in your board minutes. For example, the IRS, I said the IRS will ask for comparability data with respect to compensation. If the IRS audits you, the first thing they will ask for is your board minutes. So you want to have a good set of board minutes. It doesn't have to be very elaborate, but it should be accurate and to the point. So what are the penalties here? We talked about self-dealing. The penalties are financial penalties. With conflict of interest, the penalties are a number of different varieties. One is the risk of bad press, the reputational risk, the perception, the optics. For some of the more interesting cases, they often end up on the front page of the local or national paper. It might trigger, a conflict of interest might trigger an IRS audit, or it might trigger a review by the state's attorney general. The state's attorney general has jurisdiction and enforcement authority over charitable organizations in the state, including private foundations. And especially with respect to conflict of interest, because the IRS deals with the self-dealing rule, that's the IRS, the tax version of the conflict of interest. The state attorney general doesn't really have jurisdiction to enforce the self-dealing rules, but what they have is the authority to enforce conflict of interest, which implicates, as a matter of state law, the duty of loyalty, which is a fiduciary duty. The duty of there are two duties: the duty of care, to act with care and make informed decisions, and the duty of loyalty, which requires fiduciaries, board members, and others to act in the best interest of the foundation. And that's where the state attorney general authority comes in. Again, conflict of interest still may trigger penalties from the IRS if there are other problems found during an audit. And the state attorney general has very broad powers to remedy a conflict of interest violation. Again, usually in the cases that are egregious and where there really is a financial self-dealing, a financial benefit that's happening, The state attorney general even has the power to remove board members from the board of a foundation. So a couple of tricky situations. Again, right? I mean, so how do we think about this, right? So we just go through our questions, our framework. So follow the self-dealing definition. Think about first, is it a self-dealing? If it's not self-dealing, then follow your conflict of interest policy. And then think about anything else, reputation, optics, anything else that you think may affect your decision in whether approving a particular transaction or not. Again, talk about a couple of examples. So, what is it? The first one, daughter versus sister of a foundation director is an employee of a grantee. This is remember, the sister is a sibling, so it's not a self-dealing issue, whereas a daughter would be a disqualified person. So that is self-dealing. With the sister, that would be a conflict of interest. Trustee, the second example, trustee provides legal versus landscaping services to the foundation. This implicates what is the definition of personal services. Legal services, that falls within personal services. That's appropriate under the self-dealing rules. Landscaping services do not fall within the definition of personal services. That would be a self-dealing. And you wouldn't be able to do it. Here's a chart, just to summarize what we talked about, sort of a handy chart to help orient, the basic definition, the potential penalties, and how to deal with that, what to do. I always find this as sort of a handy chart to send around. Okay, Mark, I think we can do some more questions.
Okay, we've got plenty to work with. So there's a couple of groups of questions that I've been kind of going through. One is if you could talk a little bit about reasonable expenses. So things like there's questions around, what about business class airfare or the types of type of accommodations that are oftenly, within the philanthropic community, it's not uncommon for conferences to be held at pretty nice hotels and things like that. Is there any type of concerns or documentation that they need to do there?
Yeah, again, it's a good question. For those, a lot will depend on optics. I would say that from a legal perspective, what I tend to see in the industry, and I think it's going to be somewhat based on what the industry as a whole is doing. Generally it will be to certainly prohibit first class, except maybe in some sort of medical situation. I would say that usually business class is also frowned upon for domestic travel. For international travel, that's typically permitted. In terms of locations, I think what you have to sometimes watch out for is, certainly in the family foundation context, is where it's efficient to combine a family retreat with a foundation board meeting, and then the issue becomes how do you allocate the various expenses? And if you allocate it fairly, for example, based on a time allocation, that should be reasonable and permissible. But overall, it is going to be looking at what other organizations are generally doing, and then the optics as to what you think, how the community or others will potentially perceive the foundation in this regard.
Okay. could you go to one more slide? Did you actually bring up the Signature Plus slide?
Yes, no, I did not.
There.
And let me say a couple of
Okay.
things about publication. So, two things. One, I think as Mark mentioned at the beginning, Exponent Philanthropy is a membership organization. It's a membership for members are various grant makers of all sizes and shapes. Tend to be those that don't have a professional staff, but are run from small to very large ones as well. Through Exponent, you can submit to Exponent's staff all sorts of questions about that you have with respect to managing a foundation. And they have encountered those questions before, and they can point you in the right direction. They have sort of issue briefs and a lot of different publications that run through grants management that also cover self-dealing and conflict of interest and sort of a legal overview of foundations. Very, very good publications. I use them, and I send them to clients. I think they're great. Exponent has also, in November, rolled out a new membership category that allows direct access to an attorney with expertise in foundations to ask questions, legal questions about your foundations and managing the foundation, including self-dealing issues, conflict of interest issues, grants, making international grants, and anything of that sort.
Okay, great. I just wanted to bring that up because there are a lot of questions we're not going to get to, and so if you are an existing Exponent Philanthropy member, you might want to look at the Signature Plus. But I'll hit a couple other ones that have kind of come in that are, again, some of the broad topics. One that came up several different times were things around like tickets to events that are sent to the foundation. So from grantees and things like that, how to handle those. There's people who've been advised to give them back and not to accept them. There's questions of if they can donate them instead. There's also questions as far as, sometimes it feels like they should be attending because that's part of representing, continuing the support of the organization. So
Okay, I'll take that first. It's a good question. It's a common issue. Again, it's hard for me to say this, but at the end of the day, it really depends on the specific facts. As a general matter, you certainly can send them back. You can also give it to others. I had situations where maybe it's an event at a museum or a music event or something like that, where it may be appropriate to have others, whether it's a school group or specific individuals. Maybe there is others in the community. You can work with schools or other organizations, the senior citizens organization, where others would be able to use it. And that would be within your charitable purposes, and that would be a good use if as a way of giving it away. So I think a number of creative options that I've heard foundations and how foundations use these tickets. You can also certainly, when you make a grant, let the grantee know that you don't want to get the tickets, and that might actually require a phone call. Because I sometimes find that grantees are sort of are on automatic pilot, and they'll send you a tax receipt, where of course you don't need a tax receipt as a foundation, and they'll send you all sorts of stuff. So reaching out beforehand can be useful, and then in some cases it may be appropriate to attend that event. Again, understanding why you're doing it. Is it to carry out the purposes of the foundation and to primarily benefit the grantee, to show support, etc. So I think there are circumstances where it is appropriate. If you give a grant every year to the theater or to the opera, and they give you tickets to Puccini, is it appropriate for you to go and have a good time at the opera? Once a year, twice a year, 3 times a year, to listen to the music. That's, you could make an argument that, you don't really need to be doing that. But it can depend. So hopefully that helps a little bit as to what different organizations I've heard of that do what they do with these in these situations.
Okay, we're at an hour, but I'm gonna sneak one other one in that's
Sure.
kind of come up fairly common on here, if you will allow me to.
Yes.
There's a lot of questions about family offices and family businesses where the two are related but not. So, questions about receiving services from family offices, receiving services from family businesses, um, though, dealing with not necessarily spouses, but children, organizations that children's are part of. So there might be, children who sit on a board of something else, but they're not directors of the organization. So kind of the family side of it, which is not surprising with Exponent Philanthropy.
Yeah, and family offices are also often dealing with the foundation's investments, maybe involving grants management. So anything that the family office does that falls within the personal services definition, the foundation can pay the family office to do, and that's permissible. Um, the family office, it gets a little complicated, right? Depending on the structure of the family office, whether the family office itself is a disqualified person. Um, you know, Typically it is, and even if it isn't, it may be best, just as a rule of thumb, as a best practice, to treat it as it is, as if it were, and proceed accordingly. Um, but that sort of the overall comment is you need to figure out what services the family office is providing. If it falls within the definition of personal services, then you can pay the family office for. And they can help with grants management, grants due diligence, um, all of those various various issues.
Great. Okay, do you want to quickly throw back up your slide with your contact information? I think you had.
Oh,
There you
sure.
go. All right. So we've hit the end of our hour. There are a ton of questions that we could certainly go through, but as we anticipated, there's just not enough time to go through it. A lot of the questions are ones that are fairly specific as far as can we do this within our specific area. I'll let Andras agree with this or not, but generally what we've worked with clients on is the best thing you should do is you should have your advisors, your auditors, and your legal counsel, and often they can provide situational advice as well as documentation. Would you agree with that, Andras?
I do. I do. And again, hopefully the framework that we talked about in terms of analyzing self-dealing and whether it is self-dealing will help you. Um, but you're right that it can ultimately be a very fact-specific analysis, and it also depends whether you want to interpret the rules conservatively or or not. And even if it's maybe permissible under the self-dealing rules, it's something that you want to do. There's a number of different ways to think about the issues.
Great. So with that, we have reached the end of our hour, I guess hour and 5 minutes. So thank you everyone for sticking with us for that extra couple of minutes, and thank you, Andras, for taking an extra question or two as well. I would like to say thank Exponent Philanthropy as well as Andras for joining us today, providing this insight. Thank you to all of you who've taken time out of your busy schedules to participate as well. There will be a follow-up email that will include both recording of this webinar as well as the slides and additional documentation and relevant information as well. So do be looking for that. And if you have additional questions, you may certainly reach out to either Exponent Philanthropy. You have Andras's information there as well, and he can certainly potentially engage with you as well. And on behalf of everyone here at Foundant Technologies, the people at Exponent Philanthropy, I would like to thank you all for taking your time. When you do log out of the webinar, you will be presented with a short survey, just giving us feedback on what you think of today's webinar. Please do fill that out. provide us your feedback. We do take that into consideration on how to make these better going forward. We do see doing more and more educational webinars for the sector, so look out for those in your email as well. So with that, thank you to everyone for joining us, and have a wonderful day.
Thank you, Mark.